Hi, my name is Jorden and it's great to see you on the channel once again, and I hope you stay to learn how to maximize your monies with dividends. So there are two main groups of investors when it comes to investing. We have one group that buys growth stocks and see huge swings in the market. And we have another group that does mainly dividend stocks, earning a stable stream of passive income. So both these methods can earn you some form of income, and there's no better or lousier strategy between these two, but more of what's your risk appetite, what are your goals, and what are your situations, which makes you decide which strategy to pick over the other. And in today's video, we'll go through the differences between each strategy, who might be suitable, and how you can get started with this. So first, let's talk about growth stocks. So in a growth stock strategy, buying growth stock is somewhat similar to investing in a startup. But the main difference here is that the growth stock companies already have a working product, a business model, and ideally have some profits before they get listed onto the exchange. So growth stock companies includes companies like Etsy, Zoom, and Shopify. So these companies are growing very rapidly, which is something that many investors want. So look at it this way. Imagine you have bought Shopify when it first got listed back in 2017, and at its peak, it went up all the way to $1,500 in November 2021 before coming down to $380 in today's prices. And this is the pros of growth stocks. They always provide very high growth potential, especially when a product or services is something sought after and something that changed the way the world works. So one example is like Zoom. So Zoom started trading at $62 when it first got listed in 2019. And during the COVID period, when the world came to a standstill, companies realized that remote working became a necessity. And it was that 3 months of COVID that made every single company in the world realize that it is possible to work remotely without borders, and that has somewhat changed the way the world works. And this event made Zoom price go up to almost a high of $500, which is almost a 10x. However, such situations do not happen all the time and usually might be a once in a decade kind of situation. And this brings us to the problem of growth stocks. So no doubt growth stocks can bring us growth potential. It can also go the other way around, which is a downward trend. So Tesla, which is trading at an all-time high of $1,200, is currently trading at $663, which is a 50% drop from its all-time high. But looking back, growth stocks like Tesla also have a very high PE ratio, which is a price to earning ratio. The price to earning ratio is a measurement of how much investors are willing to pay per $1 the company earns. So the PE ratio is calculated by using the formula price per share divided by earnings per share, which will give us a number, which is the PE ratio. So for example, Tesla has a PE ratio of 89.73, which means that investors are willing to pay $89.73 for every $1 that Tesla earns. And this is incredibly high. So compared to the S&P 500, which is the benchmark that many take, the S&P 500 has a PE ratio of roughly 30. And if we were to look at other big tech firms like Apple and Microsoft, they both have a PE ratio of 31 and 27 respectively, which I personally think is kind of fair value on my books. Other than being volatile and expensive based on PE ratio, growth stocks seldom or pay very little dividend, and most growth stocks do not pay a dividend other than blue chips like Apple and Microsoft. Thus, to earn money from growth stocks, one will have to trade stocks, which means buying low and selling high. And this brings even more risk because your money is sort of locked in these stocks, and if there's another black swan event, to cut losses, investors will either have to sell their shares and wait for a better entry, and let's be honest, we do not have a crystal ball, and therefore it is impossible to time when is the best time to buy, and sometimes when we think it's the dip, it continues dipping even more. Dip. So now let's look at a dividend strategy. So this strategy is something that I use personally, so I might be a little bit biased, but do hear me out. So the concept of dividend is very simple. Imagine investing in a food stall and you own some shares to the food stall, and the food stall runs its business as per usual. And at the end of the month, you get a share of profits, or what we call dividends. But this is an oversimplification because the stock market works same but different.
Same, but different.
So something to understand is that not every stock pays you a dividend, and for those that do, it pays across a different time, like monthly, quarterly, semi-annually, or annually, depending on the company. And by investing in these companies, it builds a stream of passive income with dividends that will pay you as long as you hold on to the stock. So what dividend investors do is to reinvest their dividend back into dividend-paying stocks, which allows them to compound their passive income, and over a long enough period of time, it can become a solid stream of income. So one other pro of a dividend stock is the ability to purchase ETFs that consist of high dividend yield stocks, which gives you diversification and doesn't require you to stock pick, which I'm really bad at. So one of my favorite dividend ETF is SPHD, which consists of the top 50 out of the top 75 dividend paying stocks all in one ETF, and it pays a dividend of 3.4% on a monthly basis, which comes up to roughly 10 to 15 cents per month. But if you're not into ETF and would like to pick dividend stocks, some of the key information to look out for are payout ratio, strong cash flow, and low debt to asset ratio. So these are important because when a company pays out a dividend, they are taking cash out from their profits to pay investors who have invested in them and are promised a dividend payout. So though the dividend strategy might seem like a no-brainer because you get paid on a regular basis in cash, which gives you more cash flow to reinvest, but there are also red flags to look out for, like high dividend payout ratio of more than 70%, which means that the company might be using too much of their profits to pay investors, which leaves them with very little to reinvest into the business and might make them stagnant, and with little to no growth, this can ultimately affect your overall investment. So let's talk about who is suitable for which strategy. So there is no right or wrong in which strategy you pick, but the first thing you might want to look out for is to look at your current portfolio and see how much risk you have. And then ask yourself if you are going to take on more risk by investing in growth stocks, which can give you profits to move on into dividend stocks. Or do you want to start building a dividend income stream so that you can start compounding your money early on? For some, they might start investing in growth stocks and getting those gains and moving them into dividends to start reducing their risk and start generating income. So others might just solely invest in dividend stocks, which provides them a passive stream of income and allows them to comfortably reinvest into more dividend stocks, growing their pile of money. So if you think about it this way, having a dividend stock is like having a farmer who will plant the crops, water them, harvest them, and then sell them for money. And the more dividend stocks you have, the more farmers you have, and needless to say, the more income you will have as well. And starting this stream of income is as easy as researching dividend stocks that are out there in the market. So there are plenty to choose from and across different markets as well. And if you are going towards the US market, do understand that there will be a 30% withholding tax, which means that every time a dividend is distributed, 30% will be taken as taxes. So for example, if let's say you purchase stock ABC and it distributes a dividend of $1, but what you receive is 70 cents after taxes, and this will be applicable for all dividends from the US market. But if you're looking to just explore the Singapore market or SGX, we do not have a capital gain taxes in Singapore, and whatever dividend is distributed, it will be given back to you 100% with no taxes or no fees. And depending on which brokers you use, the dividend will either be deposited back into your bank account or into your brokerage account where you can use them to purchase even more stocks. So my strategy for dividend investing is basically buying ETFs because it frees up my mind from reading too much information about an individual stock, and it allows me to focus on my job, which is currently what brings home the bread. But on the side, I do have some blue chip growth stocks which I hold because I want to have that growth opportunity when it happens. At the end of the day, if you choose to go full on into dividend investing, just keep in mind that you will not see huge growths over the years, but you will be constantly receiving dividends on a regular basis, which can be recompounded, or you can use them for other purposes as well. So if you have found value in this video, do give me a solid by hitting the like button, subscribe if you haven't, turn on the notification to get notified, and I'll see you in the next video.